Hello, and welcome to REIT Magazine's Weekly Report. I'm Matt Bichard.
And I'm Alan Kenny. In our first story this week, REIT stocks dipped slightly in November. The FTSE NAREIT All-REIT Total Returns Index was down 0.64% for the month. Equity REITs fared slightly better, down 0.29% in November. REITs trailed the broader market for the month, as the S&P 500 was up 0.58% in November. NAREIT's Brad Case spoke with REIT.com about the November returns.
Investors looking for strong income-performing stocks can find it more dependably among REITs because as long as REITs are still earning income, they're still distributing it to their shareholders.
Multifamily REITs AvalonBay Communities and Equity Residential teamed up to acquire the Archstone apartment property portfolio from Lehman Brothers. AvalonBay and Equity Residential will fund the $6.5 billion purchase with a combination of cash and stock. AvalonBay will acquire 40% of Archstone, with Equity Residential taking the remaining 60%. The deal scuttled Archstone's plans to go public with an IPO that was projected to raise as much as $3.5 billion.
In international news, the European Public Real Estate Association announced that the global assets and exchange-traded funds linked to the FTSE EPRA NAREIT Stock Index series have grown by more than 90% in the last year. $7.1 billion are now invested in the ETFs, up from $3.7 billion at the end of October 2011. The FTSE EPRA NAREIT Global Total Return Index of developed market real estate stocks gained more than 17% during that 12-month period. EPRA CEO Philip Charles sat down with REIT.com during REIT World in San Diego last month to discuss the increased appetite for listed real estate from large institutions across Europe.
We see big differences in Europe. You have players like APG, known to everybody, one of the biggest pension funds in the world. They have about 25 billion exposure to real estate, 50% to the indirect and 50% in listed. You take a similar size of player like Allianz, one of the biggest insurance companies in the world. They have the same size of portfolio in real estate, and they have almost 100% dedication to direct. So big differences.
You used to know them as Entertainment Properties Trust, but not anymore. The Kansas City, Missouri-based company unveiled its rebranding effort in November. The firm will now be known as EPR Properties. The announcement came as EPR was celebrating the 15-year anniversary of its IPO. EPR President and CEO David Brain talked with REIT.com at REIT World 2012 about the company's makeover.
What prompted the move is really the feeling we had that sometimes we'd outgrown the name, we'd developed the company beyond just a particularly cinema and a limited entertainment focus, spanning out into education and some of the recreation areas in which we're investing. And it was time to expand the definition, the identity of the company to conform really with the portfolio we're developing.
As 2012 draws to a close, REIT analysts and investors say capital structures and strong market fundamentals have been among the market's dominant stories this year. A number shared their thoughts on the year with REIT.com at REIT World.
I think overall the fundamental story for the year has been stabilization of operations and fortress-like balance sheets that position the stocks, position the companies very well for the year ahead.
Even though the economy has been on a modest growth pace, REITs have been able to generate, by our estimates, about 8 to 10% underlying cash flow growth.
There's demand among investors for companies that own hard assets, that are run relatively conservatively, that have strong balance sheets, that have the ability to withstand downturns.
That does it for this week's edition of Weekly Report. We'll be back next week.
And in the meantime, be sure to check in with realestateinvestmenttoday.com and REIT.com for all the latest commercial real estate industry news and analysis.